China holds $3.2 trillion in U.S. dollar assets, treasury bonds, corporate bonds, currency reserves, and mortgage-backed securities. That's more dollar exposure than any other nation on Earth, more than Japan, more than the UK, more than all of Europe combined. For years, analysts, politicians, and financial media have warned about the same apocalyptic threat. What if China dumps it all? What if they weaponize their treasury holdings and flood the market with sell orders? The dollar would crash, interest rates would spike, and the U.S. government would face a funding crisis. American economic dominance would end overnight. It's been called the nuclear option, a financial weapon of mass destruction, the ace up China's sleeve that keeps American policymakers awake at night. But here is what nobody tells you. China can't use it. Not won't, but can't. Because the moment they pull that trigger, they would destroy themselves, not just damage their economy, but completely annihilate it. The $3.2 trillion isn't a weapon. It's a trap. Both the United States and China are locked inside it with no easy way out. This is the most sophisticated financial hostage situation in history. Two superpowers, each holding a gun to the other's head, both knowing that pulling the trigger means mutual destruction. What makes this terrifying isn't the threat of what might happen, but the slow-motion unraveling that is already underway. China knows they're trapped, and for the last 15 years, they have been quietly trying to escape, buying gold, building alternative payment systems, and shifting their economy away from dollar dependence. But the trap is so deep, the exposure so massive, that escape could take decades. The critical question isn't whether they'll get out, but whether the trap will collapse before they do. Let's examine exactly how this trap works, why it's inescapable, and what is happening right now as both nations try to navigate their way out without triggering mutual annihilation. The anatomy of the trap. First, let's look at the so-called weapon itself, China's dollar holdings. As of mid-2025, China holds approximately $731 billion in U.S. Treasury securities, the lowest level in 16 years. In 1 month alone, they cut $25.7 billion, the steepest single-month reduction in nearly 2 years, dropping them to the third-largest foreign holder behind Japan and the UK. But that's not the full picture. Not even close. Corporate bonds, estimated at $300 or $500 billion in U.S. technology, financial, and industrial corporations. Currency reserves, another $500, $700 billion in cash dollars, sitting idle. Mortgage-backed securities, roughly $200 billion in the same instruments that triggered the 2008 crisis. Equities, state-linked entities hold an estimated $1 or $1.5 trillion in U.S. stocks. Add it all up, and China's total dollar exposure is between $2.8 and $3.5 trillion. The commonly cited $3.2 trillion is a midpoint estimate that represents the sheer scale of China's dollar trap. This number isn't just large, it's structural. This money isn't easily moved. It's embedded in China's entire economic system. China accumulated these dollars over 40 years through one mechanism, trade surplus. From the 1980s onward, China exported goods to the world and was paid in dollars. The People's Bank of China had to do something with these trillions, so it invested in the safest, most liquid asset, U.S. Treasury bonds. This created a self-reinforcing cycle. Buying treasuries meant selling yuan and buying dollars, which kept the yuan undervalued. An undervalued yuan made Chinese exports cheaper, which led to more sales and more dollars flowing in. China's entire export-driven economic model was built on this mechanism. The $3.2 trillion is not separate from their economy. It is the accumulated savings of 40 years of growth. This is the first layer of the trap, the fantasy of the nuclear option. So, what would theoretically happen if China pressed the button? They issue a sell order for all $731 billion in treasuries at once. The market seizes, bond prices collapse, and yields spike to 8%, 10%, or higher. The cascade would be brutal. Housing market. Mortgage rates, tied to the 10-year treasury, would soar to 13 to 14%, freezing the market and collapsing home prices. Consumer economy. With 70% of U.S. GDP reliant on consumer spending, a collapse in home equity would push the economy off a cliff. Corporate debt. Companies unable to refinance at skyrocketing rates would default, triggering a credit crisis. The Fed's dilemma. The Federal Reserve would be forced to print hundreds of billions to stabilize the market, causing inflation to explode. Government finances. The U.S. government's annual interest payment on its debt could double to $2 trillion, creating an immediate funding crisis. This is the nightmare. But here is the reality. China would destroy itself even faster. Why it's a suicide pill, not a weapon. The moment China dumps its holdings, the dollar's value plummets. If the dollar loses 30% of its value, China immediately incurs a 30% loss on its other $2.5 trillion in dollar-denominated assets, a $750 billion evaporation. That is a 22% hit to their total foreign exchange reserves, a solvency crisis for their central bank. The damage accelerates from there. Export collapse. 20% of China's GDP comes from exports, with the U.S. as the largest buyer. A collapsed U.S. economy and a yuan that has surged 43% in value would make Chinese goods unaffordable, shuttering factories and causing mass unemployment. Domestic debt crisis. Chinese corporations have borrowed an estimated $3 trillion in dollar-denominated debt. A surging yuan makes this debt 43% more expensive to repay, triggering a wave of defaults and a domestic banking crisis. Energy inflation. China imports most of its energy, which is priced in dollars. A weaker dollar means they pay dramatically more in yuan for the same oil and gas, fueling rampant inflation. The U.S., with its deep capital markets and the dollar's global role, has shock absorbers. China's state-controlled, export-dependent economy is far more fragile. The nuclear option is a gun China has pointed at its own head, the Great Escape, and why it's too slow. Knowing they are trapped, China is executing a slow, three-pronged escape plan. Buying gold. They have massively increased their official gold reserves, a timeless, non-dollar asset. Building alternatives. They created the Cross-Border Interbank Payment System, CIPS, as an alternative to the dollar-dominated SWIFT. They are also signing bilateral currency swap agreements, creating a growing network for settling trade in yuan, bypassing the dollar. Shifting to domestic consumption. By rebalancing their economy to rely more on their own consumers, they reduce their need for export dollars and slow the accumulation of new dollar assets. The problem? This is a decades-long project. The yuan's share of global trade is only around 7%. Shifting the foundation of the world's second-largest economy is like turning a supertanker. It happens slowly. China is perhaps 25% of the way to a safe exit. At this pace, full diversification might take until 2045 or 2055. The race against time. This creates a terrifying race. China needs 20-30 years to escape, but the U.S. dollar is being debased from within. With the U.S. national debt soaring and the Fed printing money, the dollar's structural problems suggest a potential crisis within 5 to 10 years.
China is trapped. They can't dump dollars without self-destruction, but they can't hold them without being destroyed when the dollar collapses on its own. The ultimate irony is that the U.S. is trapped too. Washington cannot use its full financial arsenal against Beijing, like freezing assets as it did with Russia, because doing so would force China to dump its holdings, triggering mutual assured destruction. China's dollar holdings act as a deterrent, constraining U.S. policy. What happens next? Over the next 5 to 10 years, we will see China continue its slow diversification and the U.S. continue its debt accumulation. The dollar's share of global reserves, now at 57%, will continue to fall. When it drops below 50%, confidence could break, and the shift away from the dollar could accelerate from a walk to a run. We are likely facing one of 3 scenarios: orderly transition, 20% probability, a managed shift to a multi-currency system with no major crisis. Crisis transition, 50% probability. A triggering event causes a sudden loss of confidence, leading to a chaotic global financial crisis. Mutual collapse, 30% probability. The dollar collapses under its own weight before China escapes, devastating both economies. None of these are good. The best case is managed decline. The worst is mutual annihilation. The final takeaway: this isn't about the U.S. versus China. It's about recognizing that the 2 largest economies are locked in a financial structure that no longer benefits either, but from which neither can cleanly exit. The $3.2 trillion is a mutual liability, not a unilateral weapon. As this trap destabilizes, the value of traditional currencies will be caught in the crossfire. This is why understanding the trap matters. You can't change the outcome, but you can position yourself outside of it by holding assets that exist beyond the dollar-yuan standoff, like gold, productive businesses, and other real assets. The $3.2 trillion trap is the most important financial story of the decade, and it's one that both governments are quietly hoping will hold together long enough for them to find a way out. But the cliff is crumbling, and the timeline is running out.